After experiencing the highest interest rates since 2001, today the Federal Reserve has made a significant decision for the month of September. But hold on to your seats, because this might not be the end of the story. Recession indicators are flashing red, and mortgage demand has plummeted to levels we haven't seen since 1996. If that's not alarming enough, here's a shocker. Americans today are more concerned about running out of money than they are about death itself. Imagine that. One survey even predicts that people could find themselves financially drained as soon as October. So buckle up, folks, because there's a lot unfolding that isn't getting enough attention. But before we dive into the nitty-gritty of what this means for all of us, let's talk about some of the biggest market dangers related to these rate hikes. One of the major factors driving this roller coaster is inflation, and it's not slowing down. Just recently, on September 13th, we learned that overall inflation has surged by 3.7% year over year, up from the 3% we saw back in June. The shocking part is what's causing these price hikes. Brace yourselves, frozen vegetables are up by a staggering 14.7%, salad dressing by 12.1%, uncooked beef by 10.7%, and even chewing gum is up by 9.4%. Car insurance has jumped by 19%. Likely due to labor and materials becoming 17% more expensive. Shipping fares have also risen by nearly 10%, but fear not, we'll discuss how sponsorship stations can help alleviate that. And here's the big one. Rent for a primary residence has skyrocketed by 7.8%, making up a significant chunk of the overall inflation surge. On top of all that, gas prices have shot up by 10.6% in August, contributing to one of the most significant inflation spikes we've seen since June 2022. Now, you might be wondering, why isn't the Federal Reserve in panic mode? Well, they prefer to look at another metric when deciding on rate hikes, the core CPI. This fancy term excludes the more volatile categories like food and energy, which can be influenced by seasonal factors. And guess what? When you strip those items away, the core CPI actually decreased from 4.7% in July to 4.3% in August, aligning with expectations. But here's the kicker. It's housing that's giving inflation a hefty push, especially rent. If you take shelter out of the CPI equation, we'd only be looking at a meager 1% annual increase, which means the Federal Reserve would have already hit its 2% target if it weren't for those pesky landlords continually raising rents. Now, when might this rent situation ease up? Well, rent growth has started to slow down, and median rents nationally fell year over year in August. However, it takes time for these rent trends to reflect in CPI measures. So it's not quite the meddling landlords causing the inflation spike after all. But speaking of housing, let's take a closer look at the housing market, because there's a lot to dissect here. On the surface, national housing prices have gone up by a solid 2.5% from a year ago. But don't pop the champagne just yet. When you factor in increased mortgage rates, your monthly payments are now a whopping 19% more expensive than a year ago. Owning a house has become quite the pricey endeavor. According to CoreLogic's recent report, the annual resurgence reflects 6 consecutive months of gains, driving prices up by a staggering 5% compared to their low point in February. And here's the twist. Those 11 states that saw the most substantial home price declines are mostly in the West, but don't expect this trend to last long. Inventory shortages in those markets are causing recent buyer competition, which is heating prices up again. It's not surprising that the main reason housing prices are soaring is due to a shortage of available properties on the market. So, as we navigate this financial roller coaster, keep your eyes on these key factors. And as always, if you appreciate our swift analysis and updates, don't forget to hit the like button and subscribe to our channel. There's more to this financial roller coaster. With mortgage rates reaching new heights, homeowners with existing loans are in no rush to sell and trade them for pricier ones. But for prospective buyers, there's a glimmer of hope. Inventory is slowly trickling onto the market, though it's a trickle that feels more like a drip. Now here's the twist. Despite fewer homes being sold, sellers aren't budging on their asking prices. In fact, there are even fewer price reductions compared to last month. Wondering why? Well, some sellers might be pulling their homes off the market, holding out for a more favorable time, perhaps next year. It's like they're playing a waiting game. Another theory is that we won't see significant price drops until the entire housing market takes a significant hit, which isn't happening just yet. Looking ahead, the current low inventory suggests that home prices in 2024 could remain fairly stagnant. But hold on tight, because we're not done with the economic frenzy.